A couple days ago, there was an article published on Seeking Alpha titled Very Bad News for Realty Income that's received a lot of attention. Since being published, it's received hundreds of comments, so it's fair to say that it's been a highly discussed article. And when you come across a title like this, you can't help but feel a shiver go down your spine a little bit if you're a shareholder of this company. Seeing something like this brings up images of bankruptcy or corporate scandal or something so fundamentally bad that it's going to result in losses. So in my opinion, very bad news should include something that is genuinely awful. This article includes 5 pieces of bad news about Realty Income, which I'll discuss in this video. My goal here is to be as objective as possible, and I will give the author credit where I believe it's due. To be upfront, I am a shareholder of Realty Income, and I have been for years. I'm a fan of the monthly, dependable income it pays me, and I continue to reinvest my dividends to buy even more shares. I also hold plenty of other REITs, but I would say Realty Income is probably the REIT that turned me onto this sector in the first place many years ago. Obviously, no company is perfect, and Realty Income isn't the best REIT in every possible category. In the beginning of the article, the author states that they used to be a shareholder of this company, but they sold all their shares back in December of last year. It seems odd to me that they'd be writing this article now after all these months, but I guess there's nothing technically wrong about that. The author also states that they aren't shorting this company either, for full transparency. The first point made is that Realty Income's portfolio quality has been greatly deteriorated. It says, Realty Income used to be perceived as a net lease REIT that's focused on higher quality net leased properties, but those days are over. As Realty Income grew larger in size, single asset acquisitions were not moving the needle as much anymore, so they began to target accretive M&A deals to grow at a faster rate. They first acquired VEREIT, then they bought a big portfolio from CIM Real Estate Finance Trust, and then more recently Spirit Realty. But the cost of these deals is that I think that they greatly reduced the average portfolio quality of Realty Income. This of course does not mean those buyouts were poor investments, but it diluted its portfolio quality, which will increase risks going forward. I've covered some of these things on this channel, including the Spirit Realty acquisition last year. Realty Income has been doing more of these acquisitions in the last few years, but I don't believe it's resulted in a greatly deteriorated portfolio. This sounds way too dramatic for me. When Realty Income acquired VEREIT, they didn't actually acquire their entire portfolio. They spun off all of VEREIT's office properties into a new REIT called Orion Office REIT. If you owned Realty Income at the time, you actually got free shares of this REIT in your brokerage account. It was ultimately the right move and a really good example that the company still has good standards in terms of what they'll hold in their portfolio. Even just looking at their real estate portfolio today, after all these acquisitions, Realty Income still has an occupancy rating of 98.6%, far above industry average. A lot of what they've been acquiring falls in line with what the company does well at managing, and even with some of the outlier properties like Wynn Resort Las Vegas, it appears they got a really good deal on them. So overall, I would disagree with this point. I don't think it's resulted in a greatly deteriorated portfolio based on the numbers. The second point is that Realty Income has gotten way too big for its own good. Another issue with these M&A deals is that they massively increased the size of the company, and I believe that it has now become so big that it'll suffer diseconomies of scale going forward. To understand why, you need to consider that acquisitions are one of the main sources of growth for net lease REITs. Typically, their rent escalators are limited to just 1 to 2% per year, and to grow faster, they have to acquire new properties. They raise new capital at cost X and attempt to reinvest it at return Y, hoping to earn a spread that results in growth on a per-share basis. But this also means that the size of the portfolio is a limiting factor. The bigger you are, the harder it becomes to grow because new acquisitions don't move the needle as much anymore. Realty Income is currently the 5th largest REIT in the world, so it definitely is big in terms of size. There's still plenty of options for Realty Income to grow. They've been expanding internationally in recent years, which unlocks even more opportunities for them. Thanks to their size, Realty Income also has an A- credit rating, which makes debt cheaper for them. I would also suggest thinking of the flip side here. If too big is bad, then that seems to imply that smaller is better. In terms of potential growth, then yes, smaller REITs can potentially grow at a faster rate. I would agree with that part. However, this also comes with more risk. We have seen smaller REITs with fewer properties in their portfolio have to cut their dividends because even just a handful of their tenants couldn't pay rent or a couple of their properties remained unoccupied for too long. I do understand the concern here, and I think it's probably the best part of this article, but I don't see this as a good reason to completely give up on Realty Income for something different. As a steady monthly dividend-paying investment, everything that they've been doing so far appears to be fine. I won't say everything's been perfect because it hasn't, but everything has just been moving along pretty smoothly. Seeking Alpha also has these dividend growth stats, which show their 5 and 10-year dividend growth rate. People have been complaining that this company hasn't been growing their dividends as much as they were decades ago, which is true, but their growth rate is already much higher than most of their peers. So if you're looking for a different REIT that offers a higher dividend growth rate, you're not going to find too many options out there that exist, especially ones that have moats and decades of performance like this REIT has. So I'm not that overly concerned about this point either. Point number 3 is that Realty Income is losing its focus. Realty Income started with the acquisition of a Taco Bell property in 1969, and for most of its existence, it has focused primarily on similar service-oriented net lease properties. But in the past years, Realty Income has had to step out of its main circle of expertise because there wasn't enough acquisition opportunities in its niche to reach its huge acquisition volumes. This pushed Realty Income into invest in a casino, vertical farming properties, data centers, industrial properties, and in Europe. I view this very negatively because you cannot be a jack of all trades and expect to earn superior returns. This is another thing that I've discussed in the past on this channel. This company's move into vertical farming I thought was pretty interesting, but I didn't see it as a huge concern because it makes up such a small part of their property portfolio. I suppose I can see how a lack of focus could be a concern for their future. Again though, this isn't terrible news and they've been doing just fine up to this point despite not being focused on their core for many years now. Realty Income looks for good opportunities based upon their research on how profitable a piece of real estate can be, and just because it's in a new sector doesn't necessarily mean it's bad or concerning in my opinion. Point 4 is that its cost of capital is too high to pursue accretive growth. Realty Income has crashed along with the rest of the REIT market, and it is today priced at a historically low valuation, increasing its cost of equity. Then on top of that, interest rates have surged, also increasing its cost of debt, and as a result, it is not able to earn a spread on new acquisitions today. This explains why the REIT has guided to only acquire $2 billion worth of assets in 2024, down from nearly $10 billion in 2023. It also explains why they guided to grow their FFO per share by just 2% in 2024, adjusted for the impact of the merger with SRC. They are still growing thanks to their lease escalations and the reinvestment of their retained cash flow, but their growth rate is now far below its historical average. There's valid points to this, but I personally don't see this as being a permanent issue for the company. The whole REIT sector has been battered in this high interest rate environment. If you believe that interest rates are going to remain very high for a very long time, then that would negatively impact Realty Income, but also along with every other REIT out there. I still believe that because of their higher credit rating, getting debt for them will be cheaper. The final argument in this article is that it offers a worse risk to reward than its close peers, and the author then provides some alternative suggestions. He recommends stocks like Agree Realty and Triple N, which I also agree are really great companies. Ultimately, I just don't feel like this article justifies running away from Realty Income. UC makes some good points here, but I'm confident that the management team at this REIT knows what they're doing in a more challenging environment. I think the title for this article is also unreasonable. Had the title been 5 Reasons Realty Income Might Suffer or Might Underperform, then I wouldn't be even making a video about this. But again, I will give him credit because some valid points were made, and the author is a very knowledgeable person when it comes to REITs. But I really just wasn't persuaded by this article. If you prefer Agree Realty or Triple N, that's completely fine because they're both excellent companies. But that's just my opinion here. It's just an author using an over-sensationalized title, and there isn't anything here in my opinion that's actually terrible. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher-yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.